بسم الله الرحمن الرحيم، والصلاة والسلام على أشرف المرسلين سيدنا محمد النبي الأمي وعلى آله وصحابته أجمعين. أهلا بكم في المحاضرة رقم 4 هنغطي فيها إن شاء الله. We are going to cover chapter 3 of our course Financial Management and Investment. Professor Dr. Tamer Mohammed Shahwan with you. In this chapter 3, we are going to cover one of the most important topic in finance. It's called financial ratios and financial performance. By the end of this chapter, we are seeking to achieve the following goals and objectives. Number 1 is to understand who uses financial ratios and why. 2, use ratio to analyze a firm liquidity and activity. Number 3, discuss the relationship between debt and financial leverage and the ratio used to analyze a firm's debt. Number 4, use ratios to analyze a firm profitability and its market value. And finally, use a summary of financial ratio and the DuPont system of analysis to perform a complete ratio analysis. First of all, before we explain the main ratios that we are going to use, we need raw data. Our raw data of information that will be used in analysis of financial performance, actually it comes from financial statement. One of the most important financial statement is the income statement. Income statement provides a financial summary of a company's operating result during a specified period. This type of income statement can be prepared quarterly, could be prepared semi-annual, could be prepared yearly. Although such a type of income statements are prepared quarterly for reporting purpose, they are generally computed monthly by management and quarterly for tax purposes. Here, this is the standard form of a specific income statement. As you see, it starts by sales revenue minus cost of goods sold. This will give us gross profits. Yes, all types of operating expenses such as selling expenses, general and administrative expenses, lease expense, and depreciation expense. Total of the operating expense will be subtracted of the firm gross profit, resulted in what we call operating profits. Sometimes we could refer to the operating profits as earnings before interests and taxes. Such earning interests before interests and taxes, we must subtract the interest expense out of it. This leads to net profit before taxes. Then we execute a firm's taxes. This will give us what we call net profits after taxes. Sometimes we refer to net profits after taxes as net income. Part of this net income will be paid as preferred stock dividends, so the remaining part will be known as earnings available for common stockholders. Based on the decision of the board of directors, if they decided to distribute part of our net income in a shape of dividends, a part of it will be paid as dividends for common stockholders. The remaining part after the distribution of dividends will be forward as retained earnings part for the coming year. Accordingly, based on such a given information, we could calculate what we call earnings per share, EPS, and we could calculate dividends per share. This is the standard form of the company's income statement, and you must be aware of the main component of such statement. Another type of financial reports and financial statement which is necessary for computing the financial ratio, it's called the balance sheet. What is the balance sheet? The balance sheet, it presents a summary of a firm financial position at a given point in time. This is why at the end of each balance sheet we refer to it, this is the balance sheet of firm X on the 31 of December of a specific year, because it's a reflection of a firm financial position at a given point in time. As we know from accounting, any balance sheet, it can be defined by the balance sheet identity. The balance sheet identity can be expressed as total firm assets should equal the total firm's debt plus the owner equity. The total assets of the firm existed in the left-hand side of this balance sheet, which reflects the firm asset that the firm owns, against the right-hand side, which reflects the financing concept that could be done by either using debt or using the equity. At every point of time, your total assets must equal total liabilities plus owner equity. And this is a typical form of a specific company balance sheet. As you see in the left-hand side, we have a total asset which consists of total current assets plus total net fixed asset. Total current assets, it includes cash, marketable securities, accounts receivable, and inventory. Net fixed asset, it consists of our total current assets minus the accumulated depreciation. This will give us net fixed asset. Sum of total current assets and net fixed asset will equal total assets. On the other hand, in the right hand side of this balance sheet, we will have a section related to liability and stockholders equity. Liability and stockholders equity, it is the sum of total liabilities where total liability, it is the sum of total current liability and long-term debt. Plus, we have the ownership equity, and this ownership equity includes preferred stock, it includes common stock, it includes paid in capital, in excess of par in common stocks, and finally retained earnings. The sum of total liability plus total stockholders equity should give what we call total liability and stockholders equity, which at the same time must equal the firm total assets. So you must aware of what is the balance sheet, and you must aware with the main components of this balance sheet. Additionally, financial statement or financial report, it's called statement of retained earnings, which reflect the net income earned during a given year minus any cash dividends paid, showing the change in retained earnings between the start and the end of that year. The retained earnings statement, for example, here we starting with the earning balance at the starting time. Our retained earnings balance on the 1st of January 2012, for example, it is 1012 plus any net profits after taxes for the same year, for example here 231. Then we are going to exclude any types of cash dividends, either for preferred stock dividends and common stock dividends. In our example, our preferred stock cash dividends is in amount of 10. Our common stock cash dividends is in amount of 98. So the total dividends paid is 108, will be excluded of a net profit after taxes, and this will give us retained earnings balance at the end of the period, which is the 31st of December in 2012. All of this information, you must aware of such information because it will be used as inputs for our financial analysis using financial ratios. Let us start by why we need to use the financial ratio. Actually, we have many interested parties regarding the use of the financial ratio. One of the interested parties in using financial ratio, what we call current and prospective shareholders. Current and prospective shareholders, they are interested in the firm current and future level of risk and return, which directly affect share price. Another interested party, creditors. Creditors are interested in the short-term liquidity of the company and its ability to make interest and principal payment. The third interested party is management, is concerned with all aspects of the firm financial situation, and they attempt to produce financial ratio that will be considered favorable by both owners and creditors. As you see, we have different purpose that the financial ratio can be used, and we have different interested parties, and this increase the importance of this topic. How we could conduct the financial analysis using the financial ratio. Actually, we have different types of ratio comparison. The first type is called cross-sectional analysis. Cross-sectional means we are going to compare different financial ratios at the same point in time. Yani for instance, I have company X, company Y, company Z. We are going to calculate the financial ratio for these companies at the same point in time. Therefore, cross-sectional analysis could involve comparing the firm ratio to other firms in its industry, or what we call comparing the ratio with the industry average. In this industry average, for example, if you are working if your firm is working in a cement industry, for example, you calculate the financial ratio of your firm in a specific year, and then you are going to compare this year with the industry average of cement, and based on this comparison, you will be able to determine whether it's okay or not. Also, one of the important term, and you must aware it when we aiming to compare the ratio, it's called benchmarking. What is the benchmarking? Benchmarking is a certain type of cross-sectional analysis where the firm ratio in a specific year are compared to those of a key competitor or group of competitors that it will wish to emulate it. Yani if I'm working in industry and we have, of course, competitors, so when you are comparing the financial ratio of your firm with your competitors that you are seeking to emulate, in this case, it will be considered as benchmark. Here, this is an example of a comparison between the financial ratio of a specific firm with the industry average. For example, if we are interested to assess the inventory turnover, this is one of the famous financial ratio for 2012. You could compare the ratio of your firm regarding inventory turnover for 2012 with the industry average for 2012. In this case, through such a comparison, you could determine how is the level of your inventory turnover, whether it's good or bad. And I think this is the important thing for the decision maker, because as we will see, the matter, it's not only calculating the ratio, because as we will see, could everyone calculate the ratio? But the most important thing for the financial analysis is how you are going to interpret this type of ratio, and such interpretation play a very important role in deepening your understanding regarding the financial performance of your firm. This is why it's not only a matter of calculating the financial ratio, but you must compare it either with your competitors, such as using benchmarking, or comparing your ratio with the industry average, which is a certain type of a cross-sectional analysis, and based on such a comparison, you could determine whether this ratio is good or bad. Here, as you see, for example, in the computer industry, for example, we have two firms. such as Dell and Hewlett Packard. Those are most famous producer of computer. As you see, we calculate different types of financial ratios, such as current ratio, quick ratio, inventory turnover ratio, average collection period ratio, total asset turnover, debt ratio, net profit margin, return on total asset, return on equity. We calculate this for every firm such as Dell and Hewlett Packard, and at the same time to express whether this ratio is good or bad, you must compare it with the industry average. As you see, we have computers. This refers to the industry average. For example, it's 2.5, 2.1, and so on. But through the comparison between each ratio and the industry average, we could determine whether this is good or bad. Another type of using financial ratio, we could make a comparison through a time series. It's called time series analysis. Time series analysis, it's referred to, you are aiming to evaluate the firm financial performance over time using financial ratio analysis. And for example, if there is a firm, you could calculate a specific financial ratio over a period of time, for example, 5 years. For example, you could calculate current ratio in 2016, the same ratio in 2017, the same ratio in 2018, the same ratio in 2020, and through the comparison between this ratio over a specific period of time, you could get a hint, meaning understanding how is the situation of this ratio. Yani in a very simple way, time series analysis aims to conduct a comparison of current to past performance using financial ratio. Such a comparison will enable financial analysts to assess the firm progress. Sometimes when we conducting the financial analysis, we didn't just use one approach, but in most of cases, most people prefer to use the both of two approaches in conducting the financial analysis. And this is actually the most informative approach. The most informative approach is to combine cross-sectional and time series analysis, and this will increase your understanding, and it will be known as combined analysis. As you see, this figure 3.1 reflects the idea of combined analysis, where we use both of cross-sectional and time series analysis in studying or investigating the financial performance of a specific firm. As you see, we are going to use the industry average over a specific period of time from 2009 to the end of 2012. At the same time, we are going to calculate the financial ratio of the Barclays firm, the same financial ratio of Barclays firm over the same period of time, and through a comparison between those, we could explain and understand how is the financial performance of a specific firm in a specific area and activity. As you see, when you're conducting the financial performance, either using cross-sectional analysis or time series analysis, or both of them, you must have certain type of cautions about using financial ratio. Number one, you must be careful that ratio that reveal large deviation from the normal, it's an indication of the existence of a specific problem in this area. Yani, for example, if I compare inventory turnover of my firm with the industry average, if I found a large deviation between two ratios, this could be an indication of a specific problem in this area. Also, one of the important caution that using a single ratio does not generally provide sufficient information from which to judge the overall performance of the firm. Yani if you are going to judge the overall performance of a specific firm, you must aim to use different types of ratio. One ratio is not enough. Also, when you are going to use a financial ratio for conducting financial analysis, you must use the same financial statements dated at the same point in time during the year. And for example, if I would like to compare between the financial ratio in 2012, I must compare it with the industry average in 2012. I would like to compare between turnover ratio in 2015, I must compare it with the industry average in 2015. Otherwise, there is no sense of conducting such analysis. Also, when you decide to use the financial analysis, you must depend on audited financial statements. Of course, audited financial statements, they reveal much trust, disclosure, transparency than non-audited financial statements. So it is preferable to use audited financial statements. At the same time, it's better when you're comparing between a firms, you must ensure that the financial data being compared should have been developed in the same way. Sometimes you must be careful that the information can distort the analysis, so the results can be distorted by inflation, and you must take this in your consideration if you are going to depend on financial analysis for conducting, for assessing the financial reforms. Ratio analysis, to explain the purpose of the financial analysis, we are going to depend on data existed in the balance sheet and the income statement existed in tables 3.1 and 3.2. But all of data existed in the balance sheet and the income statement in tables 3.1 and 3.2. We are going to use them in conducting our financial analysis. Let us start by ratio analysis. When I say ratio analysis, it means not only one single ratio, but actually we could classify the financial ratio analysis into different dimensions. The first dimension is concerned with the liquidity level of the firm. The second, or what we call short-term liquidity. The second dimension is concerned with the activity, yani what is the efficiency of using our resources. The third dimension is concerned with debt level in the organization, or what we call long-term liquidity or leverage. The fourth dimension is mainly concerned with the profitability position of a specific firm. And finally, the fifth dimension is concerned with the marketability. How is the market situation of our firm? Let us start by the first dimension, which is mainly concerned with liquidity ratio. To assess the liquidity performance of a specific firm, especially short-term liquidity, we could actually use three types of ratio. The first one is called current ratio. Current ratio equals to current assets divided by a current liability. As you see in our example, by dividing current assets to our current liability, our current ratio is equal to 1.97. What does it mean? It means that our current assets are enough to cover our current liabilities about 2 times. And this is the most important thing. In studying this part, don't give only attention to how we calculate the ratio, because as you see, it's not a big issue. Everyone is able to calculate current ratio by dividing current assets by current liability. But the most important thing for the financial analysis is to understand what does it mean. In this example, a result means that our current assets are enough to cover our current liabilities about 2 times. But in this situation, we must ask ourselves whether this is good or bad. Actually, answering such a question only based on this ratio is nothing. We couldn't answer it, because to determine whether it's good or bad, this ratio in 2012, it must compare to its competitors in 2012, or must be compared by the industry average in 2012 using a benchmarking techniques. Through a comparison between our ratio in 2012 and the ratios of competitors, we could determine whether this is good or bad. Another type of ratio, it's called liquidity ratio. And the previous ratio, many studies informed us that it's not accurate enough. Why it's not accurate enough? Because if you give a look for a current assets, it consists of cash, account receivable, marketable securities, and inventory. If you give a look for this, you will see that the inventory is a yes asset that could be converted into cash. Yani you will need a lot of time to convert this inventory into cash. This is why most of the studies recommended that if you would like to assess the short-term liquidity in an accurate way, this inventory must be executed from the current assets, and this gives us what we call the quick ratio. The second type of ratio, it is called quick ratio. Quick ratio equals to current assets minus inventory divided by current liability. Based on our data, our quick ratio, it's equal to, as you see, it has been dropped from 2 to be 1.51, reflecting an accurate estimate of the firm short-term liquidity. Another extreme form of assessing the liquidity of the firm is to calculate what we call cash ratio. Please be careful about this. It's called a cash ratio. What is the cash ratio? Cash ratio is going to only depend on cash as a measure of liquidities, of the liquidity inside our firm. يبقى in this case the cash ratio it's equal to the cash existed in my firm divided or related to our current liabilities. As here this table giving you the main difference between current ratio and the quick ratio and justify why quick ratio is more accurate than the current ratio. As you see, we have three companies. When we calculated the current ratios for these firms, we could conclude that the current ratio for the three firms equal 1.3. This is a reflection that all of those firms having the same liquidity position regarding their short-term liquidity. But actually, this is not true, because if we extend our analysis using quick ratio, we will find that the best position regarding the short-term liquidity is going to the company where the quick ratio of it equals 1.2, and the less level of liquidity is going to US where its quick ratio is 0.2. I think this table gives us a good justification regarding the main difference between the current ratio and the quick ratio, and you must be careful of such a difference. Another shape of ratio, it's called activity ratio. And activity ratio, the main purpose of this ratio is to assess the efficiency of using the firm resources. Whether my firm is efficient in using its resources or not. How could we assess such efficiency? By using the following sub-ratios. The first one, it's called inventory turnover. Inventory turnover equals to cost of goods sold divided by our inventory. Using our data, we could conclude that the inventory turnover equals 7.2. As I told you, the meaning of this ratio is important. What does it mean? It means that this firm efficiency in managing its inventory, it's equal to 7.2 times per year. Yani this firm is able to get rid of its inventory about 7.2. At the same point, this number itself is nothing, but as I told you before, it should be compared with the competitors and must be compared with the industry average. This previous ratio, which is the inventory turnover, also we could have a good interest if we convert it from times to actual days. In this case, we must calculate what we call average age of inventory turnover. Average age of inventory turnover, it's equal to 365 divided by inventory turnover. By average age of inventory, it's equal to 365 divided by the previous inventory turnover. In this case, we converted 7.2 to a number of days, in this case equals to 50.7 days. 50.7 days means that this firm is able to get rid of its inventory in about 50.7 days. Another sub-ratio related to the activity ratio, it is called average collection period. Average collection period, it's equal to account receivable divided by average sales per day. In this case, the average sales per day could be determined by dividing the annual sales by 365, which is the number of days per year. In this example, by implementing our equation, we will find that account receivable divided by the annual sales to 365, it's equal to 59.7 days. What does it mean? It means that our team responsible for collecting our account receivable, he is able to collect our account receivable in almost 60 days. If I would like to answer whether this is good or bad, this must be compared with the competitor's average collection period, and through the comparison we could determine whether this is good or bad. Another sub-ratio regarding to activity ratio, it's called average payment period. Average payment period, it's equal to accounts payable divided by the average purchases per day. Average purchases per day, it's equal to annual purchases divided by 365. By compensating in this equation using our data, we will find that the average payment period, it's equal to 95.4 days. What does it mean? It means that this firm is able to pay its accounts payable obligations in 95.4 days. Is this good or bad? As I told you before, it must also compare with other average payment period of their competitors, and based on this we could determine whether this is good or bad. Another sub-ratio that could be used for assessing the activity ratio, it's called total asset turnover. Total asset turnover, it's equal to sales divided by total assets. Using Bartlett Company data, the total asset turnover, it's equal to 0.85%. What does it mean? It means that for every dollar invested in our total assets, we are going to generate 85 cents in a shape of sales. But again, 0.85 means for every $1 invested in our total assets, we are going to generate 85 cents in a shape of sales. Is this good or bad? You also should compare this with the industry average to answer such question. The third dimension, I think now we covered 2 dimensions. We cover if you are interested to assess short-term liquidity, you are going to use 3 sub-ratios. If you are interested to assess the efficiency of using resources, we are using 5 ratios. The third type of financial analysis, it's called debt ratios. Debt ratio, one of the very famous sub-ratio in this dimension is debt ratio, which equals total liability divided by total assets. Using our data, the debt ratio it's equal to 45.7%. It means that in this firm they are going to depend on debt by about 45.7%. So the remaining part of our total assets will be financed through the equity. By using a debt ratio, it's a reflection of how we are going to finance our total assets based on debt. So it's a reflection of the debt situation in my firm. Let us continue. Another ratio related to debt ratio, it is times interest earned ratio, which equals to EBIT, earnings before interest and taxes divided by interests. In this case, we will see that the times interest ratio it's equal to 4.5. What does it mean? It means that our earnings before interests and taxes are enough to cover our interests about 4.5. Is this good or bad? You need to compare it with your competitors. Another fourth dimension regarding to the assessing the financial performance, it's called profitability ratio. And as you see, profitability ratio could be assessed by different sub-ratios. The first one is a gross profit margin, which is equal to sales minus cost of goods sold divided by sales. By compensating in this equation, our gross profit margin is equal to 32.1%. What does it mean? It means that for every dollar generated in a shape of sales, our gross profit margin, it will be in an amount of 32.1 cent. Another sub-ratio, it's called operating profit margin. Operating profit margin is equal to operating profits divided by sales. By compensating using data, our operating profit margin it's equal to 13.6%. It means that for every dollar generated in a shape of sales, our operating profit margin is equal to 13.6 cents. Third sub-dimension ratio regarding profitability is net profit margin. Net profit margin is equal to earnings available for common stockholders divided by sales. In this case, by compensating, we will find that the net profit margin it's equal to 7.2%. This means that for every dollar generated in a shape of sales, our earnings available for common stockholders equal to 7.2 cents. The fourth sub-dimension of our profitability ratio, it is called return on total assets. Return on total assets, ROA capital, ROA, it's equal to the earnings available for common stockholders divided by total assets. By compensating the equation, it's equal to a return on assets equal to 6.1%. It means that for every dollar invested in our assets, this dollar is going to create certain type of earnings available for common stockholders in an amount of 6.1 cents. Another important ratio, it's called return on equity. Return on equity, ROE. ROE, it's equal to earnings available for common stockholders divided by common stock equity. In our data, we will find that the return on equity, it equals to 12.6%. What does it mean? It means that for every dollar existed in our equity as a fund, this is going to create earnings available for common stockholders in an amount of 12.6% or 12.6 cents. Almost you must take into consideration in the return on equity is higher than return on assets. The fifth dimension is concerned with assessing the marketability of your firm, and in this case we are going to assess the market ratios. One of the famous form of market ratios is earnings per share. Earnings per share is equal to earnings available for common stockholders divided by number of shares of common stock outstanding. As you see in this our data, earning per share is equal to 2.9. Another important ratio in the market ratio, it's a relation between price to earnings. It's called price earning ratio or BE ratio. BE ratio, it's equal to market price per share of common stocks divided by earnings per share. In this case, using our data in our firm, we will find that the BE ratio, which is a ratio between market price to the earning per share, it's equal to 11.1. And finally, the relation between a market to book ratio, or sometimes it's called MEB ratio, and this is a measurement of the risk affecting market risk affecting the firm. It's a relation between market price per share divided to book value per share. But in this case, market book ratio equal to market price divided by the book value. How could we determine the book value per share of common stocks? Book value per share of common stocks will be determined by the relation between common stock equity divided by the number of shares of common stock outstanding. The common stock equity divided by number of shares of common stock outstanding, this will give you the book value. Then we compensate in the previous equation to determine the relation between market to book ratio. As you see in our example, we have a equity which is an amount of 1,754,000. We divided by number of shares outstanding, which is 76,262. This gives book value per share in an amount of 23. Then we refer our market value of this share, which is 32.25, divided by a book value which is 32. So in this case, the relation between a market to book value is equal to 1.40. At the end, you must try to summarize all types of ratio you have been calculated as what is existed in this table. As you see, we have the ratio, we have the dimension of ratio, such as liquidity, activity, debt, profitability, marketability, and then we have how we calculated the ratio, the formula used in our calculation, and then years over which we calculated this ratio. We calculated it over 3 years, 2010, 2011, 2012. Then we have a column, it's called industry average. It's important if we would like to make a comparison between the firm ratio and the industry ratio. And such a comparison could be conducted. Either we are using cross-sectional, it's evaluation using cross-sectional 2012, or we are making an evaluation using a time series between 2010 to 2012. As you see, example for a current ratio in 2010 is 2.04, in 2011 it's 2.08, in 2012 80 bit decrease 1.97. When we compare it with the industry average, it's okay, it's almost around the industry average. According to the cross-sectional 2012, it's 2.08, our industry average 2.05, so it's okay. According to a time series, also it's around, and there is no much increase or decrease, so it's a reflection of a good short-term liquidity. It's okay, so our overestimate is okay. But sometimes maybe you could describe it as a good, or maybe you could describe it as a poor, and in general you are going to describe it as a good or poor or okay, and this is the interpretation and the assessment of the financial performance over different years using time series or using cross-sectional analysis. The last part in our lecture, we have a system, it's called DuPont identity. According to the DuPont identity, we are going to concentrate on one of the very famous ratio. It's called return on equity. Return on equity could be measured either by its short form, where return on equity is equal to a net income divided by total equity. But however, this short form didn't reflect us the main component and why there is increase or decrease in the return on equity. This is why the DuPont system provided an extension of how we calculate the return on equity. Such extension of calculation of return on equity, it will enable us to determine strengths and weaknesses in the sub-component of the return on equity, and this will increase our understanding regarding the profitability of my firm. According to the DuPont identity, we could classify a return on equity into three sub-ratios. Number one is the operating efficiency ratio. Number two is asset use efficiency. Number three is the financial leverage. Operating efficiency ratio, it's measured by profit margin. يعني خدناها قبل كده. Asset use efficiency is measured by total asset turnover. I think we explained it before. Financial leverage, it's measured by the equity multiplier. But in this case, we could split a return on equity into three sub-components. As you see, return on equity, this is the short form, which is net income divided by total equity. Could be expressed in a shape of return on assets multiplied by the equity multiplier. Again, return on asset could be expressed in a shape of net profit margin multiplied by asset utilization. As you see, the long form for calculating a return on equity, according to the DuPont identity, it's equal to profit margin multiplied by total asset turnover multiplied by equity multipliers. The equity multiplier, it's a total asset divided by equity capital. By compensating in each sub-dimension, profit margin, it's 15.7, total asset turnover, it's 0.64 multiplied by the equity multiplier, which is 1.39. In this case, it will equal to 14%. It's the same result of the previous short term, but by extending the return on equity into its sub-dimension, this will increase our understanding regarding how is the profitability and what are the main reasons behind increasing or decreasing return on equity. At the end of this lecture, we explained a very important topic. It's called financial analysis. A main purpose of such financial analysis is to assess the performance of your firm. For assessing the performance of your firm, you could assess it based on different dimensions. You could assess it based on short-term liquidity, or activity ratio, or debt ratio, or profitability ratio, or marketability. Or you could assess the overall performance using the 5 dimensions. Also, one of the very famous ratio, it's called return on equity. This return on equity could be measured by its short form, but this short form will not help us to understand the reason behind increasing or decreasing this ratio. So we have what we call two-bond identity. They splitting the return on equity into its 3 sub-dimensions, including profit margin, total asset turnover, equity multiplier. Such categorizing of the main components of the return on equity will help you to understand the main reason behind increasing or decreasing the return on equity. At the end of this lecture, I wish you all of the best and waiting your questions, and see you inshallah next time. All the best. Professor Tamer Shahwat. Shukran.